Welcome. Well, that's a bummer. Let's try the other code and see if that works. Copy that. Let's go here, maybe. See if this works. Control A, Control V. Save. Edit. So that's not it. We go here. Why is it not? There it is. All right. Cool. Wow. All right. We got it to work. Welcome. If you're just joining us, go ahead and put where you're from in the chat. I'd love to see where everyone's from today. Welcome to the event We'll be getting started shortly here. Go ahead and put where you're from in the chat if you don't mind, please. Love to see where everyone's from. Thanks so much. Welcome to the chat, welcome to the webinar. We'll get started here shortly. Go ahead and put where you're from in the chat, if you don't mind, please. Love to see where everyone's from. Thanks so much. We'll give it a couple more minutes and then I'll get started probably 2 minutes after. Welcome to the webinar. I just wanted to take a second and introduce myself, tell you a little bit about what you'll be learning on this webinar today. Do me a favor, if you can hear me, type a 1 in the chat, just so I know that I don't have any audio issues going on. I'd appreciate it. All right. Thank you, Jimmy. I appreciate that. All right. All right. So let's get rocking and rolling here. All right. So what we're going to be talking about today is VA mortgages, some of the myths, some of the confusions, and I'm going to answer some of those questions for you. So, what are we going to the mission objective today? We're going to let you know who you work with matters, right? It's important that you know who you're working with. Three questions you should ask every single person that's on that you're selling a home to or listing a home. Ask these three questions every time. We're going to bust some myths. We're going to talk about VA appraisals and MPRs, which, let's be honest with you, it's generally the big elephant in the room. That's where a lot of issues come up with that are, frankly, I'm seeing in the marketplace quite wrong. Seller concessions, we'll talk about that. And then we're going to talk about how you can get more VA buyers for your properties or that you're working with. So how can you accomplish that for free? We'll kind of go over that here in a little bit at the end. So stay to the end for the bonus. All right. So why should you listen to me? Who the heck am I? So let's start with this. I am a U.S. Marine. I served 2 combat tours overseas, first in Panama on Operation Just Cause, secondly in former Yugoslavia and Bosnia Herzegovina. In fact, I was the very first U.S. troop on the ground in Bosnia. So a little bit more about my background. I work for Edge Home Finance. We're the nation's largest brokerage based on volume. There's some arguments on that, but as of the last report, we are the largest. I call myself the VA mortgage vet. I've been doing this originating loans since 1995. I've done well over 4,000. I think it's closer to 4,700 the last audit, but in that range. I'm a founding member of the Veteran Mortgage Corps, also a veteran home advisor and a veteran mortgage advisor. Now, you may ask yourself, what does all that mean? Well, even though I've done a lot of mortgages, I don't know everything. So I'm not going to sit here and pretend like I have every answer to every problem. Luckily enough, I work with a lot of professionals in the industry who doing VA mortgages is really important to them. So just wanted to kind of give you a heads up on who I am and why the heck you should listen to what I have to say. All right, so let's start with who you work with matters. Now, I love this quote. I borrowed it from a friend of mine, but I fear not the man who's practiced 10,000 kicks once. I fear the man who's practiced one kick 10,000 times. So what that's basically saying is if you're working with someone, you should work with someone who knows the product, right? You don't want to work with someone who's never done this. So this is specific for the state of Tennessee. Obviously, I work in multiple states, but I wanted to start with just talking about the state of Tennessee, to be frank. So last year, there were 27,443 real estate transactions in the state of Tennessee. VA mortgages, so mortgages on those properties in the state of Tennessee, were just under 12,000 of those. So a pretty significant market share, right? We're talking 43%. So VA mortgages are an important part of what we do here in Tennessee. Now, here are the 3 questions that we should talk about. The very first question you should ask is, are you or your spouse a veteran? Now, in America, there's almost 19 million veterans in America. But the reason we ask this is a lot of times I've seen this where people will assume that a female is not a veteran, and that's just not true. As you can see there's almost 1.2 million female veterans. We did about 103,000 VA mortgages last year in 2022 for female veterans. Just be careful. I'm not saying that you do, but I have seen it in my own life where people have made the assumption that the husband is the boyfriend is the vet, and that may not be the case. So, and then of those, there are still 38,000 that receive spousal support or survivor benefits due to their significant other dying in a combat theater. So it's important to ask the question because you'd hate to miss the opportunity to help that particular person buy a property. Now, the next question you should ask is if you know that they are entitled to a VA mortgage, do they receive any type of disability from the VA? So Well, let me just see here. It looks like there's some more people popping on. Cool. Let's invite them in. Welcome, welcome. Um, so right now there are 5.9 million service-connected veterans, 5.9 million service-connected veterans in the country. Every state kind of handles property tax exemptions differently. So it's important to understand that you work with someone who understands what what those look like for each state. Tennessee is believe it or not, one of the most restrictive on property tax freedom for veterans, but that doesn't mean you shouldn't still ask that question. And we'll talk about why that's important, because if they have any service-connected disability, their funding fee is waived. So they don't have to pay any additional fee to use the VA mortgage. And then lastly, do they have their certificate of eligibility? Now, I will tell you on my website, vamortgagevet.com or travisegan.com, if you scroll to the bottom on the right-hand side, there's a link for the certificate of eligibility. You could go in there and grab it. They can go in there and grab it, but you can go get it directly from the Veterans Administration. Also, competent loan officers, and there are quite a few of them in the market, they will help get that for the veteran as well. So that shouldn't be a holdup, but if they have it, it's good. It'll certainly help the process move along much quicker. So what does a certificate of eligibility look like? You may or may not have seen these. A lot of times veterans don't know what all these things mean, but really think about it in this way. This is their, Willy Wonka, right? The golden ticket. Like, this is their golden ticket. Now, while we're talking about this, you'll notice that at the top of the slide, it says, what's the difference between pre-qualification and pre-approval? I will tell you, I've seen this in the last year, more times than I care to admit. A lot of times you will see a veteran get pre-approved and the lender has not pulled their certificate of eligibility. They are not pre-approved. That's a pre-qualification. They're guessing. Don't work with a lender who does that. If they offer you a pre-approval and they have not pulled the certificate of eligibility, they have completely screwed that veteran over. Now, it may not be a problem, but I will tell you, I've seen several where it has been, where I get called to fix the deal, and I can't because they didn't pull the certificate of eligibility first. Now, understand the difference between pre-qualification and pre-approval from a mortgage perspective. Pre-qualification is simply a customer tells me they make a certain amount of money. They have a certain amount of money for down payment and closing costs. Their credit is roughly this certain score. What can they afford? It's not verified. None of the data is necessarily verified. Pre-approval, on the other hand, is a vastly different animal. We have verified the income. We have verified the assets. We have verified their eligibility for a VA mortgage. We have run it through an underwriting, either an automated system or a human being. So it's important to understand what the difference between pre-qual and pre-approval is. And I will tell you lots and lots, most lenders will misconfuse those two all the time. So just please be careful when you're working with someone. Make sure that it's been through an underwriting process, that it's actually been approved. And if it's a veteran or an active duty service member, please make sure they have their certificate of eligibility. Super important. Now, I could go through here and explain all of this to you. Just know this. If it says up here, it'll have the name of the veteran, their contact information. See where it says funding fee exempt right here? That just means they don't have to pay a funding fee. And it'll go in here and it'll actually talk about how much money they get per month from their service-connected disability, which we can then use for income as well in the transaction. All right, so let's talk about the 6th common VA myths, right? And these are things that I've seen in my career. These are things that my colleagues have seen in their career. And I will honestly tell you, some of them have lingered for so long, I don't even know where they come from. So let's start with the first one. I'm going to ask you a question. I'm going to ask you to put it in the chat. I'm going to give you 2 different buyers. And I'm going to ask you to tell me which of the 2 you think is the stronger buyer, right? You don't see this as the realtor, but let's assume that you were in contact with your lender, you knew who your lender was, and they told you about this. So here's borrower. Let's talk about buyer A. They have a 658 FICO score, average household income of about $69,000, average loan amount that they can qualify for. So what can they qualify for? of about $233,000. Here's buyer B. Median FICO score of 746, household income of just over $101,000, and they qualify for 343. Go ahead and type in the chat A or B. Which is the stronger buyer? Go ahead and let me know what your thoughts are on that if you don't mind. I know it's kind of a silly question. I know it's kind of silly, right? So these are what we call the buyer profiles that from 2022. Now you may say, Travis, we're in 2024. Why are you showing me data from 2022? It takes them a minute to compile the data. We don't have 2023 data yet. So once we do, I'll update these slides. But as of 2022, which is the last full year we have record of, the buyer on the left, or buyer A, is FHA. That's an FHA buyer. Buyer B is VA. Just because they don't put any money down doesn't mean they can't or doesn't mean they won't. And I'm going to tell a quick anecdote here. I had a customer buying a property in Hopkinsville, Kentucky. They were coming from a base out west. They were still active duty at the time. They wrote an offer that was almost $100,000 over the list price. I called the listing agent to talk to her because I knew the offer was going to look weird. And they had a appraisal waiver contingency, like they waived their appraisal contingency, right? They basically said, we'll pay $100,000 over. And the realtor was going to decline the offer. They were going to say, no, that's crazy. It's VA. They can't go over the list price. It's never going to appraise for $79,000 over the list price. Well, when I spoke with the realtor, I explained to her, yeah, they could pay cash for the property. They'll pay any shortage. They want the buyer. Now, obviously, this was in closer to 2020, 2021 area where the market was a little bit different than it is today. And the appraisal came short. We knew it would. The buyer gladly paid the difference and invested the rest. So just because they can't, be careful to make assumptions. Talk to the lender. Make sure that the lender knows what's going on. If you see something weird on an offer, reach out to the lender. So these are the data that we have as of this point. So this is most recently. This came out, I think, 2 weeks ago. So 87% of veterans use their VA benefit after active duty. 13% use it while they're on active duty, which is important for us being close to Fort Campbell. We have quite a few active duty soldiers, sailors, Marines, airmen. I don't know that I've seen any Space Force folk here, but there may be. So just know that most use their veteran benefit after they get out. So why is this important to us? Let's talk about how many veterans there actually are. So let's talk about the number of veterans in the state of Tennessee, and then the number of veterans that are local in the central Tennessee area, right? The Nashville greater area. So there are 453,625 veterans in the state of Tennessee, or about 104,000 that have VA disability compensation. So the total veteran population in the middle of the state here, right, from Clarksville all the way down, straight down the middle of Tennessee, it's about 207,000, 208,000 veterans. There are lots and lots of eligible buyers in this marketplace. Tons. Just, I want you to be aware of it because sometimes the data, while a little bit boring, can also open your eyes to what's available. Now, so we know zero down doesn't mean that they're a bad buyer. I think we can agree on that, right? Just because they don't put money down doesn't mean they can't or they won't, right? But that's their option. They've earned that entitlement. So let's talk about the second myth. The second myth are VA loans are harder to get through underwriting. So why do lenders want to do VA loans more so than an FHA or even a conventional loan, right? Let's talk about that. Because as a lender, I can tell you, VA loans are by far the most preferred loan program that's out there. And there's a very specific reason as to why that would be. So let's talk about this. When a lender lends money, their biggest fear is default, right? As a percentage, how many people in this loan category are going to default? That's why credit scoring came about, right? As they looked at percentages, where do people tend to default the most? So let's talk about portfolio of default as of 2022. Once again, that's the most recent data. The VA loan portfolio, so VA mortgages nationally, only have about a 0.63% default rate. So that means out of every 100 VA mortgages, less than one will default. It's pretty good. I mean, it's excellent. Conventional loans, right? So this is what everyone always wants. Oh, I want a conventional mortgage. I want a conventional buyer, right? They have a 3% default rate. So out of every 100, 3 are going to default. It doesn't matter interest rate. It doesn't matter what's going on in socioeconomically. 3% of that portfolio will default historically. Obviously, in 2007, 2008, if you were doing real estate at that time, the percentages were higher. The VA mortgage was dramatically lower. USDA was dramatically lower than conventional financing. And then obviously FHA has quite, significantly more, almost triple that of the conventional loan. Now you may say, why is that important to you as a realtor? Well, it's important because it's going to go to underwriting standards. So what lenders are looking for are protection from borrower default. So when Fannie Mae and Freddie Mac go into default, let's say a customer puts 20% down on a conventional loan, they have no protection. The only protection they have is if a customer has mortgage insurance, the mortgage insurance will step in and cover a part of it. Now, Ginnie Mae, which is FHA, they possibly have a claim, right? There's a possibility that the lender can get some of that money back through FHA. And on a VA, it's 100% guaranteed. Now, you may say, how do they do that? Well, we talked about that funding fee earlier. The funding fee self-funds the product. And when you have a very small default ratio, you can basically pay any default difference. Keep the math simple. $100,000 mortgage, it defaults. The odds are you're not going to be able to sell it as a realtor at what is owed, right? It's a default. They probably didn't keep it's probably got some deferred maintenance. There are probably some issues with the property. They're going to have to be addressed. Even if you fix it up and the VA allows you to do that, the VA is going to guarantee that lender. Whatever their difference from what they sell it to what they buy, what they are owed on it, the VA will cut them a check and make them 100% whole. It's the only product out there that does that. So let's talk about lender overlays. So this is my dad's favorite quote. My dad was a banker, president of the bank in the hometown that I grew up in. He said, "He who holds the gold makes the rules," right? So understand what VA is it's an insurance policy. It's mortgage insurance. And the mortgage insurance lender or the mortgage insurance provider sets the underwriting standards. Now, VA sets a minimum standard. Conventional sets a minimum standard. FHA sets a minimum standards. Lenders always have the ability to add additional criteria to it. So here are some of the most common overlays you'll see. FICO score. If someone wants to type in the chat, tell me what you think the minimum FICO score is for a VA mortgage. You know what? Why don't I just share it? The minimum FICO score is actually, there is no minimum FICO score from VA. Zero. There's none. VA does not have a credit score requirement. Lenders do. So I have a lender who'll go all the way down to 500 credit score for VA. Now, let me be clear. There better be a whole lot of compensating factors, right? Like a 500 credit score, you're probably working to get that score. So that doesn't mean just because if they meet the credit score requirement, they'll pass the rest of the loan. There has to be some extenuating circumstances with a credit score that low. What I'm saying to you, though, is the Veterans Administration itself does not have a minimum score. You may see seasoning requirements from bankruptcy discharge. So the Veterans Administration has a 2-year seasoning requirement. Some lenders will go longer than that. So just because you talk with a lender and they say, oh, the VA says this, make sure it's not a lender overlay before it's assigned to the Veterans Administration, because every lender has the ability to add additional criteria on. And then property types. VA will finance every property type. The only thing I have not ever personally closed a loan on is a mixed-use property. I have not been able to do that simply because a portion of that property is commercial and it has to be a primary residence. So, but they'll do mobile homes, condos, you name it, the VA will lend on it. So barn dominiums. So all of those things are in play with the VA mortgage. So I could tell you, going through the VA loan process, it's by far the easiest. It's the easiest from a debt to income requirement. It's the easiest. VA uses residual income calculators. So as long as the residual income is fair, they don't care. They'll do a debt ratio as high as 60% because they have the data to prove that the customer can do that. So at the bottom here, you see the little quote, "I don't need a weapon, I am one." We like to say that simply because what it lets people know is knowledge is power, right? And the more knowledge you have, the better you can serve your buyers. So VA loans take longer to close. I will tell you, this one chaps my hind end almost as much as certificate of eligibility does. So VA loans do not take longer to close. It's just frankly false. So 99% of all lenders have automatic underwriting authority. What that basically means is this: we can run it through DU, LP, we can run it through some type of an automated engine, and it will let us know if the loan is able to do that, if the customer qualifies. Higher credit score, more cash reserves, just like any other loan program, the better. I will tell you once again, the criteria for VA is much easier and much easier to validate than any other loan program. So as of 2022, 32.9 days on average to close a VA mortgage. So that's all lenders, all types, 33 days, let's call it. Our team, we're averaging about 19 days from application to close. So if I have a customer, and I do lots of save deals where I'll have a customer, I'll get a call from a realtor and say, hey, Trav, this buyer was working with XYZ lender. Can you save this deal? They declined it. And a lot of times we're able to get those. I'd love to tell you 100% that would be inaccurate, but it's certainly a higher than 50% that we're able to close, probably closer to 75. We're closing loans on 19 days from application to closing. Now, obviously, the contract will dictate the time horizon. So, but we can get cleared to close usually in 2 weeks. And so to say that it takes longer to close a VA loan is just factually inaccurate. So we've busted that. It absolutely does not take longer. So here's the one that I like to spend a little bit more time on, and this is seller must pay veterans fees. That's complete phooey. It's just phooey. Anyone who's told you that is not telling you the truth. So here's my challenge to you. I'm going to go over 7 slides, and we're going to talk specifically about what does a lender pay, what does a realtor pay, what does a veteran pay, what does a seller pay, right? We're going to go through here. Who pays for what? My challenge to you is in the next 7 slides, I want you to count how many times you see seller or seller must pay for a specific thing. So grab a piece of paper, a note, and check off there's a surprise for the person that gets this right. So how many things are we going to ask the seller to pay for? So let's go through here. So pest inspections. You've probably heard at some point in your career, the Veterans Administration requires the seller to pay for pest inspections. It's just not true. These are the actual circulars. So the circular up to 2014 basically said that any non-reimbursable fees are not included in the flat fee and are not considered. So VA treats pest inspection fees the same as any other unallowable fee. So the truth is, even prior to 2014, the buyer could pay for VA for the pest inspection fees. And I'll explain why they could. It just depends on how the lender addresses it. As of 2022, we 100% can pay for it. And if we document it, the key is we have to have an itemized invoice. That's the key, itemized invoice. As long as there's an itemized invoice, it gets paid as an allowable fee. So let's talk about some key terms. Non-reimbursable fees. Non-reimbursable fees, think about it as non-reoccurring, right? So these are going to be things like appraisal, title, water test if you're on a well, or septic test, title insurance, those type of things. One and done, right? Transaction. Itemized fees are things that are goods and services. So it's going to be purchased rather than just the total cost. So things like homeowners insurance, surveys, those type of things. Anything that's an itemized fee. It's specific fee for a specific item done. Now, at this point, this is a reminder. Sometimes realtors are veterans. I have lots of realtors who actually are veterans, and they don't understand because they're a little bit numb to it. But the VA home loan program is earned. It's the only program that the borrowers have earned it. Like this is not something that they serve the country, they get it. They've earned it. They signed a check, a blank check with their name, with their life on it. And sometimes we do ourselves a disservice. What you have to understand is the VA understands this, and the VA does everything they can to try to make it easier for the veteran. Excuse me. Apologize. So understand that the objective is to help veterans get into homes. That's the key piece of this. So fees and charges the veteran can pay, right? So what can they pay for? So any reasonable and customary fees, right? So if it's not customary, if there's a special fee that would be charged to a veteran that isn't charged to other buyers, they can't pay that. So it's just got to be reasonable and customary. Plus a 1% flat charge by the lender. Now, I will tell you that's almost never done anymore. There are a few lenders that do it. But when I first started in mortgages in the mid 90s, I can honestly tell you we charged a 1% origination fee on every single loan we did. That's no longer customary. First, plus the sizes are just, the sizes of purchase prices are dramatically different than they were almost 30 years ago. Plus, any reasonable discount points. So they can pay their fees, they can pay a 1% origination fee, and they can pay any reasonable discount points. That's allowable in the 26-7. So here are some additional fees that they can pay. So these are the types of things where people say, oh, well, you don't want to accept a VA loan because you've got to pay these fees. The veteran pays all these. Appraisal, recording, credit, prepaid items, hazard, flood, survey. A lot of states require surveys. Survey fees, title insurance, the funding fee itself, any MERS fees, other authorized fees by VA. So basically, it's hard to think of what fees they don't. But here's a specific example of where this example has come up to a couple of different times, not this exact, but very similar. So let's talk about it. Civilian paid for a water test on a property. That civilian's financing fell through. The listing agent has a backup VA offer. If the water test is still valid, meaning it hasn't expired, it's not too old, the water test is acceptable to the lender, the veteran cannot be forced to buy a new one. So we can use previous inspections, well and septic inspections in particular. What we can't do is make them pay for new ones if those aren't expired. I hope that makes sense. So here are some additional fees. The lender's flat 1% fee, right? The key piece on this, and why some lenders do this, but most do not in today's market, is that 1% needs to encompass everything: underwriting, doc prep, all the fees that go through doing a loan. Those all would fit into that 1% rule, right? So it's intended to cover all the costs. So a lot of lenders don't do that anymore. It's not pragmatic in today's market. So here are some additional fees that they can pay. So I want you to see so far what fees can't be paid for, right? They can pay for everything, right? So here's what they can't pay for. And I'd love to hear your thoughts on this in the chat. So they can't pay for attorney's fees, and they can't pay for brokerage fees. So for instance, if your brokerage charges a doc prep fee or a transaction fee or some type of fee, the veteran cannot be charged that. They also can't be charged a brokerage fee, right? So they can't be charged a brokerage fee. Obviously, with this DOJ lawsuit, there's some changes coming. We think there will be some changes in this particular provision in the underwriting handbook. But here's what I will tell you. The experiences I've had to date with this in the last month, if it's written in the contract that the seller pays it as part of the negotiation, then it's considered a seller concession and it's not considered a real estate. It's not considered a fee that the buyer is paying because the seller would be paying it. So you can still, and I'm not a realtor, I'm not licensed, so please hear me out. The way I've seen it done right now is that they're still asking the seller to pay it. It's negotiated into the contract. If you're seeing something different in the marketplace, please put that in the chat. I'd love to see that. We're kind of in a gray area right now until the Veterans Administration figures this out, how exactly they're going to do that with NAR settling that case. So I'd love to hear your thoughts on that. But as of right now, that's what we're seeing. So let's recap this myth. The veteran can pay non-reimbursable fees. The veteran can pay itemized fees. The lender can charge the veteran a 1% flat fee. So did you find any places in here where fees that the seller must pay? There aren't any. The seller doesn't have to pay for any of that stuff. Now, the buyer can ask the seller to pay for things. That is allowable, right? That's negotiable, but they don't have to pay for anything. And so I will tell you that where we saw that the pest inspection was a big one for a long time. That lenders were making the seller pay for that. As long as the lender didn't charge the 1% fee, they weren't having to pay it. So if the lender charged a 1% fee, that was an issue until 2022 when they changed it. But there is nothing that the seller must pay for that isn't negotiated. Everything must be negotiated. I hope that makes sense. I fibbed a little bit when I said that you're going to have, there's a prize. There is no prize. There are no seller required fees on a VA transaction. Now, these are some of the lenders and some of the different organizations I work with to help veterans locally here in Tennessee and in Montgomery County in particular. But I always like to spend a little bit of time on this MRP designation. If you have it, spectacular. But this is where I like to encourage you to get that, especially if you're going to work with any veterans in Central Tennessee. We have a lot of, obviously, Fort Campbell vets, but we have vets everywhere. We have vets from Memphis. There's vets in every municipality in this state. I'm a big fan of the MRP designation. I would highly encourage you get that or get some additional training. This is just a compulsory overview. Obviously, we can get into much, much more detail. I will tell you, I have gone into some MRP classes and actually, taught some of the pieces of this. So just know that there are places out there where you can increase your knowledge on this particular situation. All right. So we busted that myth. The seller has to pay veteran fees. That's just not true. So here's another myth that's a big one, and you probably know this, but maybe you don't. There's a myth that the veteran can only have one loan at a time. So the veteran was in Fort Bragg, they own a home, they're transferred to Fort Campbell, and they can only have one loan. Well, that's just not true. So let's talk about what the entitlement is. Once again, it's a mortgage insurance program, much more so than a loan program. That's I think the easiest way to think of this. So basically, the VA guarantees 25% over the loan amount for the veteran, for the institution. So here are some of the common myths associated with entitlement. You can only have one VA loan. If you foreclose on a VA loan, you can never have another one. Not true. The VA has a max loan amount. Once again, not true. Those are all inaccurate. So there are two different types of entitlement, and this gets a little confusing. So I hope you'll stay with me. When I first started in lending, we had a much smaller loan sizes, much smaller sales prices. So 36% entitlement. So you may say, where did that come from? Well, if you look on that certificate of eligibility I showed earlier, that's what it will say. It'll say the entitlement's $36,000. That's your basic entitlement. Back when my dad did mortgages in the 70s, that was more than enough to cover the entitlement. Well, the Veterans Administration realized that, hey, property values are dramatically higher today than they were in the 70s. So they did some improvements to the product, and they offered a bonus entitlement. The bonus entitlement goes up to the county max. So what's the county max? Well, In Montgomery County, it's 766, 550. Williamson and Davidson counties are bigger. Obviously, they're higher cost, so those numbers go higher. They basically guarantee 25% of the loan amount to the lender. That's what the entitlement is designed to do. So basically, they go up to 582 of insurance, $582,000 worth of insurance. Just know this: it actually goes higher than that. There is no requirement that the veteran have just one mortgage. There isn't. So a veteran could have a loan in Bragg, and Fort Knox, and Fort Campbell, Camp Lejeune, um, MacDill Air Base. They can have loans as long as they have enough entitlement remaining. Now, there is a mathematical formula, and the mathematical formula can be a little confusing. I won't go into that here, but that's why you want to work with a lender who knows what the heck they're doing, because they can go in and tell you if that veteran is eligible. All right, so let's get into the elephant. This is the one that I spend a little bit more time on as well. This is the appraisal issue. If you've ever heard that the lender, once a VA appraisal is done, it sticks to the property, right? So if the borrower buys a house with a VA loan and the appraisal comes in low, it's stuck to the property. Not true. That's just not true. So let's talk about it. 92% of all loans came in at or above value in 2022 on a VA mortgage, as opposed to 80% on conventional. Interesting, right? So VA appraisals came in higher on average than conventional ones did. Okay, well, that's good to know. Let's talk about timeliness. Now, obviously, VA sets guidelines for timelines. So in 2022, the average was 7.2 days on VA, 10.5 days on conventional. Think of conventional and FHA are very similar from an appraisal perspective. But VA is the only product that has two methods to get value back. So if it comes in short, if the appraisal is less than the contract, we have two opportunities to address that, where you do not have that with conventional or FHA loans. You don't. When the appraisal comes in, that's the number. On VA, we have two more additional bites of the apple. So the ROV, or the reconsideration of value, it's reporting that almost 8 out of 10 are getting approved, equating to an average increase in value of $28,000, right? So if we follow the process and we do what is asked of us, on average, 8 out of 10 times we're getting additional value, and they're pushing the purchase, the original value, they're pushing it higher, up on average to about $28,000. Now, the appraisal, this is the important point I started with. The appraisal report is owned by the veteran. If the transaction falls apart, the appraisal is not attached to the property. It goes with the veteran, meaning that appraisal will stay with that veteran for that property, but not with the property itself, meaning that appraisal isn't stuck to that particular buyer. Another buyer can have it appraised and get a different value. So that's the first and important thing. A lot of realtors do not understand that. So this is something that my colleagues and I talk about a lot. It's not a VA appraisal problem. It's an appraisal problem, meaning if there's not enough comps to justify that, it's an appraisal issue. It doesn't matter if it's a VA mortgage or a conventional mortgage or an FHA mortgage or a USDA mortgage. There's an appraisal problem. So a lot of times what people are upset with appraised values, it's an appraisal issue. It wouldn't matter what loan program. They use the same form. It's the same appraisal. Now, once again, there are strict timeline requirements. In Kentucky and Tennessee in particular, it's 10 days. They have 10 days to get it back, 10 business days, which is 2 weeks. I will tell you, on average, we're getting them back. Goodness. I mean, I've gotten appraisals back in the last 6 months in 2 to 3 days, depending on the market and how busy they are. So they're ridiculously fast. So that's an important thing to know, that the VA appraisal process has a hard deadline. Hard. Has to be done. And then the Office of the Comptroller, they're always looking at ways where they can take the VA's Tidewater process and they're looking to actually add that into the other programs, like conventional, like FHA, like USDA. So know that what VA is doing is kind of setting the tone for the rest of the marketplace, which we think would be a good move. So here's another big issue: MRPs, or excuse me, MPRs, minimum property requirements. So the VA has set minimum property requirements. It's to protect veterans' interests, the lenders, the servicers, and the Veterans Administration itself. So people always say, well, this is the area where people tend to get a little squirrely. So let's talk about it. This is the big piece: safe, structurally sound, and sanitary. That's what the appraisal must have. It must be safe, it must be structurally sound, and it must be sanitary. The appraiser should not make any comment if it doesn't address safe, structurally sound, and sanitary. So what does that mean? So let me give you some examples. Broken windows, lead-based paint on homes built before 1978, mold, foundation cracks that aren't normal from settling, right? Obviously, properties settle. So if it doesn't address safety, structural soundness, or it's sanitary, it should not be addressed in the appraisal. I will tell you that I come to this a lot. There are lots of times I have to remind the appraiser of this. So the appraiser should not recommend repairs for cosmetic items. So worn linoleum floors, that type of stuff, they shouldn't be calling on it if it doesn't affect the safety, the soundness, the structural soundness, or the sanitary conditions of the property. It's not an issue on a VA appraisal. Now, they can't request that they be fixed, but they should recommend it, right? They shouldn't recommend it. They should address it in valuation of the property condition overall. So you could see an adjustment down in value based on cosmetic repairs, but they shouldn't call for the repair to be done prior to close. That's the important piece. So real quick, before we get into this, I will tell you that there are lots of times I will call the appraiser and have the appraisal address whether it's safe, which is it? Is it safety, structural soundness, or is it sanitary? And I've had them go back and correct their appraisals to address those, because if it doesn't address those, it's not supposed to be in the appraiser. All right. VA has this is the two appraisal processes. So Tidewater and reconsideration of value. If you've done VA loans in the past, you'll know what these are. Hopefully you don't know what they are because the appraisal came in at value. So hopefully it's not an issue. But if Tidewater is an issue, so let's talk about the phases. So phase one, the appraiser cannot give the value. The determination of value is done by the Veterans Administration. But if the appraiser believes that the value will not meet the contract price, they must initiate a Tidewater alert. They have to. And then once that's issued, so the appraiser will let the lender know, would let us know. We then get back to you and say, hey, look, we have 2 days, usually less because there's some time, right? The appraiser lets us know, the clock starts ticking. Once they let us know, the clock is running. We have to get them 3 comps that justify the value, right? So we have to turn in 3 comps that say, okay, we think it's worth $300,000. The appraiser thinks it's worth $280,000. We give them additional comps. The appraiser then goes to phase 2. They receive the comps. They either adjust the purchase price, they say that those comps don't support the purchase price, or they've received no comps in the 48-hour period. The appraiser issues the value, and then the appraisal sends the appraisal to the lender. So effectively what happens is the appraiser sends the appraisal to the VA. The VA offers the value, and then it's sent to the lender. And then at that point, if we're not happy with it, then we go to the next phase, reconsideration of value. So what does that mean? So phase 1, we receive the appraisal back from the appraiser. We ask the staff appraisal reviewer, the SAR at the Veterans Administration. So depending on where you are, if you're in Kentucky, it's in Virginia. If you're in Tennessee, it's in Georgia. We go to the SAR and ask them to review the appraiser and see if we can't get an adjustment to the notice of value, right? So we go in. If the veteran requests in writing for the lender to initiate a reconsideration of value, the SAR will then go in and look at the appraisal, and 15% of the time they have up to a 15% authority to raise the value, right? So they can go up to 15% of the value for the veteran. I will tell you, I'll bet 9 out of the last 10, I've got the SAR to increase the value for the buyer. Market conditions have obviously played a piece in that. So just know that a good lender understands the reconsideration of value. I have had one recently where the client did not want to buy the property because there was such a deviation between the purchase price and the appraised value. They decided to buy a different property. So once again, that's on the veteran. But if the veteran wants to continue with the transaction, they certainly can. And about 9 out of 10 times, we are able to get that squared away. At least that's been my experience here locally. So here are some of the statistics. They raise it about about 20% of the time nationally. Ours is much higher than that. So about 15% of the time the appraisers are coming in low. So the ROV has about an 8. So nationally, it has about a 79% approval rate. We're a bit closer to 90. I'd say we're probably, the last data I looked at, we're like 88%. So we have a much higher percentage than this, but just know the veteran still has to make the determination that they want to initiate that piece. Okay. And then on average, it's about a 7% increase of the purchase price, or about $28,000. So believe it or not, we save transactions by using the reconsideration of value. I think that's an important piece to know, that you don't get that on your conventional mortgages. Now, as of the veterans, I always say this wrong, Blue Water Navy Vietnam Veterans Act of 2019. So starting on January 1st of 2020, there is no longer a loan limit. Meaning, if a veteran wants to buy a property, or veterans want to buy a property at $3 million, they can go 100% financing on a $3 million property. The key is that the lender has to do that. So we're talking about lender overlay again. This could be the same issue. You'll have less lenders wanting to do that big of a loan size, but we do have options. I mean, I haven't done one, but I do have a colleague who did a $5 million VA mortgage in Florida. So I know it can be done. Now, here are some of the other changes that are important. If they have a Purple Heart, obviously their funding fee is waived. Here, what the funding fees look like, how they change. So they changed with this act in 2019, effective on January 1st. These are the funding fees. Now, you may ask here, why are there differences in fees, right, for the different amounts? So if a veteran chooses to put money down, they can drop their funding fee. So let me give you, for instance, say you have a veteran who has no service-connected disability and they want to put 10% down. So instead of paying the funding fee of 2.3%, they only have to pay 1.4%. Now, this is financed into the transaction. This is where veterans get confused quite often. Veterans think this means that they can finance their closing costs, which they cannot. Closing costs cannot be financed in VA loans unless they're negotiated in the contract, meaning the seller effectively pays them. The buyer effectively raises the price to do so. So that's how closing costs can be. But the funding fee in the closing costs, this is the one where throw veterans off quite a bit. So this is new too, that a lender can certify certain issues, and we're encouraged to self-certify issues on the appraisal, except for paint. So if the home was built prior to 1978 and there is chipped or peeling paint, we do not have the authority to certify that. We have to have an expert go out and do that. So just know that homes that are built after 78, they stopped making lead-based paint in 78. So we have far less of these issues, obviously, as time moves away. I mean, that was almost 50 years ago. So if it's built after 78, we have less issues here. But a lot of the repairs we can self-certify. We can say, yep, the work has been done, and we can continue to move on. Once again, this is a overlay for some lenders. So, once again, if it's not a VA appraisal problem, it's an appraisal problem. If there's an issue with value, the VA gives you more options than any other product. If there's an issue with condition, you're going to have those issues with any other product. I don't care what anyone tells you. If you're doing a conventional loan and there's a safety, a structural soundness, or a sanitary issue with a property, the appraiser will call it out. Even on conventional, I've had conventional call for repairs. So just so you're aware, they can and will call for those things. All right. So I'm going to ask you to do me a favor if you don't mind. Grab your phone, if you're not watching this on your phone, and look at that. If this has been valuable to you, would you please leave me a 5-star Google review? I love helping realtors grow their business. It would mean a lot to me if you wouldn't mind doing that. I would greatly, greatly, greatly appreciate that. All right, I'm going to skip past here. We're coming to the end. So here's the last thing. Having a realtor who understands the VA loan process is incredibly important. We don't get a chance to talk generally to the listing agent. As a general rule, we just don't. I wish we did, but we don't. So here's an example of a pre-approval letter that I sent. So just to give you an idea of what this looks like, this goes in and kind of breaks it out very specifically, talks about some of the data that I've shown with you. But the important thing in here is to remember this is an earned benefit. It's an earned benefit. This isn't a benefit that, they just decide they want. You have to earn it. So know that having a lender that knows what they're doing. Now, as a broker, I have countless appraisals, countless lenders to work with. So if I don't get the answer I like from one, I can go to another, which I do. All right. So let's talk about some concessions. What's a VA seller concessions rule? So let's talk about it. Anything of value added to the transaction by the builder seller for which the buyer pays nothing additional is not considered versus a closing cost. Closing cost associated with the specific property, taxes, title, insurance, title is considered a closing cost. So this is where things get a little bit squirrely, right? So VA seller concessions rule is not the same as directed by HUD or FHA. It's not the same. So that doesn't work the same way. So the maximum seller concession for VA loans is 4%. I don't know if you know this or not, but as a seller, you can ask the seller to pay off a debt to help a veteran qualify for the loan. So this is not considered part of the 4%. The closing costs paid by the seller are not considered part of the 4%. So let's talk about it. Payment of the veteran's funding fee, prepayment of taxes or insurance, gifts. So if they left a TV or an appliance, a washer dryer, those type of things, that's considered a concession. Payment of extra points is beyond what's customary and normal market conditions. Escrows, and then obviously credit balances, judgments on behalf. So if this is what I was talking about, if you pay off a credit card, if you pay off a judgment on behalf of a buyer to get them into the home, the seller can technically do that up to 4%. Obviously, market conditions will dictate that. So in addition to the 4%, sellers, lenders can assist with, so this is where it gets interesting, payment of VA allowable closing costs, appraisal credit report, funding fees. So the normal traditional closing costs that we think of. Payment of points is appropriate to the market. So, Travis, how do I get buyers for free? You may be asking, well, how do I do that? Well, I'm glad we made it to this point because we're not quite done. We're almost done. So I'm having a consumer seminar next Wednesday evening at 6:30 p.m. Central Time, 7:30 Eastern Time. If you promote it, so I can create a special link for you, and if you promote it, and I'll help you with posts and those type of things on social media, then anyone who comes in through that link, they'll be tagged to you, and anyone that comes to the webinar, they're your client. You will receive a text and an email, and when they get pre-approved, you're the realtor we'll send them to. So super easy, right? So if you're interested in participating, all you have to do is type VA buyer, text to this number here, VA buyer, and I will help you get your unique link. So This is my cell phone number, 931-208-6280. If you text VA Buyer to that number, I will help you create a unique link, and I will help you get the social media post to get that going for the webinar on Wednesday evening next week. Okay, take a picture of this slide. This will be super helpful to you. This is the VA Regional Loan Center. This is where all of this happens, right? So if you have a specific question about a VA loan, say you can't get a hold of me and you're trying to make a decision quickly, call this number. If you're a veteran, you'd press 1. If you're a lender, now I will tell you, as a veteran myself, I still push 2 if I have a specific underwriting question. And even when I think I know everything, something comes up in a transaction that kicks me right in the keister. So I would encourage you to take a picture of this slide, keep it for yourself, call them. Appraisal issues, underwriting issues, they're awesome. They're great to work with, and they help all the time. Here's my contact information. If you want to take a picture of this with your phone, this has all my contact information. You can share it right into your phone. I'm here to answer any questions you may have. I hope you found this valuable. Once again, I appreciate your time. I do my best to answer this, and I'm going to scroll back up here really quick to find my QR code. So once again, if you found this class valuable, I would ask that you take a picture of that QR code. It'll take you right to Google, where you can leave me a 5-star review. I would really, really appreciate that. That'll help me grow my business, and I'd love to help you grow yours. Now, if you have any questions, by all means, please type it in the chat. You don't have to stay. I want to keep it to an hour. We're right at an hour. So if you have questions, I'd love to help and answer those for you. Or you can reach out to me. You can text me. You can text VA Buyer, and I'll help you get that link. And it looks like I have a couple of you who've already done that. I don't see any more questions. So I'm going to shut this baby down unless there's a question or a concern. But I appreciate you attending. Once again, I will be having a consumer webinar next Wednesday, April 3rd at 6:30 p.m. Central Time, 7:30 Eastern Time. And I look forward to, if you'd like to jump on that, by all means, please do. Look forward to talking to you soon. Have a blessed day. Thank you, Chris. Appreciate you. Bye-bye.